Imagine one of the world's largest economies dramatically cutting down its stakes in US debt. China, once the biggest foreign holder of the US Treasury bonds, has slashed its holding by 40%. What's driving this monumental shift? So today we will try to understand the implications of China's decision to sell off a substantial portion of its US Treasury holdings and what this could mean for the future of both Chinese and American economies. When we take a look at things from the viewpoint of US Treasury, it heavily stresses the safety and dependability of Treasury securities. However, some tend to paint another picture. They argue from a different angle and bring to light other aspects. These critics point out that the huge amount of US Treasuries being released indicates something more significant: the substantial national debt, which currently sits at $35 trillion. And the interesting part is that a record $8.9 trillion of government debt will mature over the next year. They argue that this existing debt could potentially introduce long-term economic dangers. They fear the possibility of inflation increasing and borrowing costs rising. In addition, experts underline the US reliance on outside funds or foreign investments, especially from certain nations like Japan and China. Interestingly, these two countries hold a huge portion of US debt, about $1.15 trillion and almost $800 billion respectively. This, they believe, is another reason to be concerned.
More than $1 trillion. That's what the developing world owes China, more than $1 trillion. And that makes China the world's biggest debt collector.
China's major contribution to US Treasury Securities started in early 2000s. During that time, China's economy was mostly fueled by exports. This economic model resulted in considerable trade profit from United States. As these profits began to increase, so did the foreign exchange reserves. To maintain the flow of this income and ensure its safety, the Chinese government made a decision. They began investing their money in US Treasury securities. By the year 2001, China had approximately $100 billion invested in the securities. Moving forward to the mid-2000s, there was a swift growth from 2005 to 2010. China's investment in US Treasury securities notably increased during this period. And do you know what pushed this rapid growth? China's strong policy was to maintain a stable exchange rate for their currency, the yuan. To do this, they started buying a large amount of US dollars. And this decision led to more investments in US Treasury securities. In 2008, while the world was struggling with global financial crisis, China's investments witnessed a huge surge, reaching an impressive mark of over $500 billion. But guess what? Despite the crisis, US governmental bonds were still considered as a safe place to put their money. So this perception helped China to further increase its investments. Moving in the period from 2010 to 2014, a time when China's holdings in US Treasuries reached their highest point. Between 2012 and 2014, this holding skyrocketed to over $1.3 trillion. This peak was driven by China's continued trade profits and the strategic plan to manage the value of Chinese yuan by accumulating dollar reserves. By 2014, China had become the largest holder of US Treasury bonds. Around 40% of its foreign exchange reserves were held in these bonds. This was the peak of the Chinese investment in US debt. But then, things started to change in 2015. China began slowly lowering its ownership of US Treasury bonds. There were a couple of reasons for this. First, China wanted to diversify its foreign exchange reserves to minimize the risk of holding too many assets in US dollars. Second, as a part of new economic strategy, China started focusing on promoting the global use of its own currency, the yuan or renminbi. Fast forward to mid-2019, China's US Treasury holdings had fallen to around $1.1 trillion.
China flow out of bonds. I should mention, it's not just bonds, it is stocks too. China sold a record amount of stocks, $5.1 billion in the month of August.
But the story doesn't end there. Starting in 2020, China's reduction in US Treasury bonds accelerated. This period was marked by escalating political conflicts, trade disagreements, and concerns about potential US financial sanctions. Additionally, the changing global economic landscape influenced China's investment strategies, leading them to seek other opportunities. As of July 2024, you won't believe it, China's holding fell below $800 billion. This is the lowest level since we faced the global financial crisis, making a decline of nearly 40% over the 10 years. But the question is, why does China still keep holding onto US Treasuries? Keeping US Treasuries gives China numerous advantages in the economic sector. US Treasuries are incredibly easy to trade, meaning that China can quickly convert them into cash whenever required. Currently, China is focused on diversifying its investments to manage and mitigate the risk associated with holding large amounts of US debt. As China's economy continued to grow and develop, reducing dependence on the US dollar has become a strategic priority. This is part of a wider plan to protect its economy from any possible volatility in the US financial system.
Possibly, China is a form of diversification. There's very likely to be a decoupling between the United States and China because they are going to make very different decisions about technology. And there are countries who are going to line up behind China.
This money supply ensures that China can easily access money whenever there is economic pressure or when it needs to meet urgent financial requirements. By keeping a large number of US Treasury notes, China can successfully control the value of its currency, the yuan, against the dollar. This method also assists in maintaining a winning position for Chinese goods that are sold to other countries. Hence, it stopped the yuan from becoming too valuable. Basically, they are aiming to boost the use of their own currency in global trade and finance. This change is a part of China's wider plan to have more financial and economic self-reliance. In addition to this strategic shift, market conditions have also influenced China's decision. The return on US governmental bonds aren't consistent, and with US interest rates possibly going down in the next few years, it makes sense for China to seek out alternative and potentially more profitable investment opportunities. Let's think about a big money box like the People's Bank of China, PBOC. They kind of like a piggy bank. They accumulate American dollars by selling more goods to the other countries than they buy from them. This is called a trade surplus. The PBOC then uses these American dollars to buy treasuries. This helps to keep the value of China's own currency, the yuan, lower than it might be otherwise. As a result, Chinese-made products stay competitively priced, making them more attractive in global markets. Now imagine having a ton of someone else's IOUs. That's what happens when China holds a lot of American debt. This situation creates a unique economic relationship where both China and US help each other out economically. China gets a safe place to store its foreign currency, meanwhile America gets someone who consistently buys its debt, those IOUs, which help to keep borrowing costs low and support economic growth in America. This process also works like a circular trade route between China and the US. By investing in these treasuries, China can return the dollars it has earned from its trade surplus to the American economy. This meaning goods and services can keep moving between two countries, helping to maintain steady trade relationships. Additionally, it prevents an excess accumulation of dollars, which could disrupt China's financial and business systems. Recent trends indicate that China is rethinking its approach to US Treasury holdings and adjusting its strategies accordingly. This change is a big part of a wider shift in how the world works, how countries plan their economy, and how the market is. We see this change in how China tries to spread out its investment and not rely too much on US debt. China is also considering investing in a wider variety of assets to achieve this, something like infrastructural projects and other currencies on the list. By doing so, China aims to establish a more balanced and strong economic portfolio. So what's the new plan? To diversify, spread out its foreign exchange reserves into various assets. This could include bonds from Europe, gold and other commodities. This way China can manage its financial risks more effectively. There is also a factor of political tensions. The ongoing issues over trade, technology and regional security have resulted in uncertain and mistrustful environment. These disputes have led to the strained relationship between China and the US, making the economic landscape even more complex. Political tensions, particularly between the US and China, have made Beijing think twice about depending too much on US treasuries. It's like Beijing is trying to diversify its assets by putting its eggs into different baskets. The possible threat of financial penalties or other political tricks has spotlighted the dangers related to holding a lot of US debt. This has pushed China to look for other types of investments that can lower its risk to US money rules and risk around the world. China's financial plan is changing too. The country is increasingly focused on encouraging the worldwide use of its currency, renminbi. This is a part of China's long-term goal of making the RMB a major player in the world of reserve currencies. You might not know, but Donald Trump's re-election could bring about a major change in how China manages its US Treasury holdings. During Trump's initial rule, the relationship between the US and China was a bit rocky, characterized by escalating tensions. This includes trade disputes and an increase in duties on the goods imported from China. Now, if Trump or someone with similar views from the Republican Party comes back into power, these issues could be rekindled. In response, China may decide to reassess its US Treasury investments. This would be a part of a bigger plan to lessen the financial risk tied to the political instability. If Trump were to introduce tough economic policies like raising tariffs or tightening trade rules, China would likely consider minimizing its exposure to the US debt. This way they could avert any potential financial fallout. However, a more pressing question arises. Is Beijing actually reducing its US debt? This, coupled with the potential for a wider acceptance of the yuan, indicates that the US government might have to come up with a plan. This plan would need to address how the situation affects the perception of the US dollar, which currently holds the title of the world's reserve currency. The main question is whether China has started to move its investments away from dollar and dollar-based bonds. It's also unclear if China is now keeping its assets in places other than just American or Euroclear custodians, financial institutions that hold customer securities for safekeeping. Experts say that we shouldn't ignore Beijing's shift from US debt to other resources like gold. In simple terms, Beijing trades the US debt for things like gold. This shows they want to protect themselves, especially if US decides to sanction China for trading with Russia. The penalties can include extra taxes on goods, which the Biden team might introduce. These possible issues could be the reason why China wants to have different types of investment. While some believe that China's reduction in US debt holdings is merely a tactical shuffle, this topic remains a significant interest to the global business community. The potential implications are vast and far-reaching. But only time will reveal the full impact of China's strategic shift to the global economies. And if you want to see the impact now, then hit the like button and subscribe to the channel for more interesting content. Hope you enjoyed the video, thanks for watching and see you in the next video. Bye bye.